Welcome to this presentation on optimum capital structure. Here we'll evaluate how to find the optimum capital structure of our firm by minimizing the cost of capital. The various areas to be evaluated are factors influencing cost of capital, how to minimize the cost of capital, evaluating the theory of optimum capital structure, increasing the debt equity ratio to a certain level only, measuring risk associated with the asset through asset volatility, empirically linking the volatility of an asset with the capital structure, finding volatility-based metrics like CAPM and SML, empirical evaluation of linking changes in beta of a stock to changes in the capital structure. Theories proposed to help companies optimize capital structure, benefits and limitations of available subjective theories. Conclusion, the benefits and needs of mathematical models-based capital structure theories. I am Aninda Datta, the presenter. The cost of capital represents the cost of obtaining funds for a company, both equity and debt, and is influenced by many external and internal factors. The following is an illustrative list of factors influencing the cost of capital. Creditworthiness and credit ratings, the financial performance indicators like free cash generators, timely creditors and debt payments, levels of fluctuations in revenue and earnings, level of risk management, quality of governance. The level of operational risk, how diversified and de-risked the revenue inflows are, dependence on single products and single markets, pricing power of the products. Timing of fundraising, like raising debt when the market interest rate is low reduces cost of debt. Raising fund during the high interest rate increases cost of debt. Raising equity when equity markets are high. Optimizing the capital structure by having the right mix of debt and equity, that is taking maximum benefits of tax breaks through debts without increasing default probability beyond a level. Here we see how to optimize capital structure to minimize the cost of capital. The first challenge is how to measure the cost of equity and cost of capital, observing the cost of capital in the real world. Identifying various risk factors driving cost of capital, whether the impact of changing capital structure on cost of capital is observable. Identifying various metrics in which cost of capital is reflected, like volatility. Is stock volatility really dependable metric for measuring cost of capital? Linking the minimum cost of capital in the real world with the optimum capital structure. Now, how to minimize the cost of capital by optimizing capital structure is by minimizing the weighted average cost of debt and equity, combining debt and equity in such proportion that weighted average cost is minimized. As debt is cheaper than equity, so increase the debt level initially. This will gradually reduce the weighted average capital cost. However, increasing debt level increases financial risk level. As fixed interest payment obligation rises, this increases the return expectations of both debt and equity investors. Therefore, both cost of debt and equity start rising after debt level crosses a threshold. The debt level at which the combined weighted cost of capital is minimized is called the optimum capital structure of a company. The optimum capital structure varies with industry. The industry's risk profile is higher should have optimum capital structure at lower debt equity level compared to a lower risk level industry. Here, risk level is indicated by high fluctuations in revenue, fluctuations of cost of main raw material. Commodity industry has higher fluctuations in selling price and revenue compared to the FMCG industry. High corporate income tax rate further reduces the cost of debt. This shifts the optimum capital structure towards the right side, that is at a higher debt level. The capital structure that results in minimum cost of capital is called the optimum capital structure and is achieved by mixing the right amount of debt and equity. Here is the graph that depicts the cost of capital at different levels of debt equity. As could be seen from the graph that both cost of debt and cost of equity increase gradually as debt level increases. The effect of lower debt cost minimizes the weighted average capital cost only up to a certain debt level. Beyond that, the increasing cost of debt and equity more than exceed the benefit of the lower debt cost. The minimum weighted average capital cost is achieved at debt equity level of 0.5 with the combined capital cost at 11.75. This is the level of minimum debt equity level, minimum weighted average capital cost at a debt equity level of 0.5. The industries with higher risk level, with a higher risk profile than this will have minimum capital cost at debt equity level lower than 0.5, whereas with lower risk profile should have minimum capital cost at higher debt equity level. The cost of debt is observable in the form of yield to maturity built into the bond price, but the real problem is finding cost of equity, as it is not directly observable in the financial market. The capital asset pricing model recommends a formula for calculating cost of equity, that is risk-free rate plus beta into market return minus risk-free rate. Its graphical representation is called the securities market line. This is the formula for the capital asset pricing model. This covers systematic risk of a stock. Beta used in capital asset pricing model is the ratio of covariance individual stock return and market return divided by the variance of the market return provides the systematic risk of a stock. The volatility is the broad proxy for risk of all asset classes. There is a capital market line predicts the return of equity to the relative volatility level of an asset. So it assumes all risks associated with a stock are captured in the volatility. That is, return of a stock equal to risk-free return plus standard deviation of the stock into the market Sharpe ratio. Thus, a stock with higher volatility than market has higher risk and higher cost of equity, as investors would expect higher return to compensate for higher risk. If higher volatility indicates higher risk, then there should be a positive correlation between volatility and return. The assets with higher volatility should have higher returns over long periods. This gives the performance of various asset classes over long period, standard deviation on the y-axis and annualized return on the x-axis. There is a clear increasing trend. That is, an upward sloping line could be drawn between these points. The picture is similar in this graph also. This is between 2010 and 2019. Both the above diagrams show a strong positive correlation between realized return and volatility, represented by standard deviation of returns, indicating higher volatility assets give higher returns most of the time. The actual stock return is quite different from the volatility-based beta predicted by CAPM. Let's examine the market data of Microsoft stock, that is, comparing volatility-based beta with the actual return beta. The volatility-based market beta of Microsoft varies between 0.87 to 0.98 during the last 10 years. The data is available in public domain in many websites. Let's plot the actual return in percentage on Standard & Poor on y-axis and Microsoft return on the y-axis, or Standard & Poor on x-axis with Microsoft return on y-axis. This is the graph where the x-axis contains the Standard & Poor data and y-axis contains the Microsoft data. If you draw a regression line, it becomes a sort of security market line. The slope is the beta, covariance between market and stock divided by the variance of the market returns, representing a systematic risk. There is a positive correlation between the two variables, with slope of the regression line comes at 1.5. The standard deviation is at 0.28. Thus, beta value varies with method of calculation and data granularity. R-square of 0.59 indicates a significant relationship, but stock-specific microeconomic behavioral factors also have a major effect on the stock return. Based on one stock return, it could be inferred that cost of equity based on observed volatility could only moderately predict the future stock return. However, a much bigger sample is needed to arrive at a meaningful conclusion. Now we need to evaluate the data to link variation in actual return based beta to capital structure variation. As beta of a share is a proxy for systematic risk associated with a share, so betas should vary with changes in the capital structure. So this is a graph that depicts how beta varies with the changes in the capital structure. The first y-axis shows the beta levels and the second y-axis shows the debt equity level. This x-axis shows the 4 years ending beta and this one the year. The debt equity ratio of Microsoft from 2013 onwards has been plotted. Source macro friends. The 4 years moving average of actual return data also plotted. There is a clear inverse relationship between the two variables. That is, the beta increases when the financial risk reduces, showing the opposite conclusion from the CAPM recommendation. Thus, higher debt equity ratio shows lower beta. Thus, impact on beta of other factors is much more than that of the capital structure. However, a much bigger sample is needed to reach a definite conclusion. However, relative volatility of the stock is affected by many other risk factors. So observing the effect of capital structure only on relative volatility is extremely difficult. Probably an experiment in real world is needed where principal component analysis is applied to stock volatility with the various underlying risk factors, thus clearly identifying the risk factors driving the changes in volatility. As the cost of capital is used to discount future cash flows, the discount rate, the cost of capital should be minimum at optimum capital structure, implying the highest combined value of debt and equity. But the value of the firm increases due to many other factors like increase in profitability, increase in sales. Now, many factors including capital structure influence value of a firm in the real world, but linking highest firm value to optimum capital structure is extremely difficult. So this URL shows a real-life experiment to show the impact of profitability and capital structure on the value of the firm. An empirical test to show the impact of profitability and capital structure and value of a firm. The extent of impact made varies with the industry and size of the firm. Value of company's own capital is driven both by existing profit and future profits. How much of the increase in existing profits is attributable to the capital structure is difficult to assess. Even if the firm value increase is attributable to existing profit increase, it is difficult to separate how the impact of profitability and how profit increase is caused by increase in debt equity level. As an optimum capital structure maximizes the operation profit available for shareholders after paying interest and income tax without increasing the default risk beyond an acceptable level. Thus, the profitability increase and capital structure changes are to some extent interrelated while contributing to the enhancement of firm value. One may argue that capital structure at a time when the firm has the highest price earning multiple is optimum capital structure. But P multiples are driven more by future growth expectations rather than by the capital structure changes. Thus, empirically observing the optimum capital structure in low standard deviation or highest firm value of a firm does not seem feasible. So optimizing cost of capital through matrix of standard deviation of return or firm value is extremely difficult in real world. Therefore, companies may use some of the models to optimize the capital structure in real world. This is a website which provides details of methodology of capital structure optimization. Major theories developed to help optimize capital structure. Trade-off theory. It states that optimum debt level is arrived at by setting off increasing leverage against the increasing bankruptcy cost. The bankruptcy probability is at different time in future is calculated based on the different scenarios, whereas each firm decided the acceptable probability level of bankruptcy. The pecking order theory. This states that managers operate their firms in a way to minimize the need to secure outside finance by retaining profits. Managers will use the safest source of funding as senior debt whenever fundraising becomes a necessity. There is no well-defined debt equity ratio, but different sources of internal and external funding in a pecking order. Market timing theory. This theory predicts that firms attempt to time the market by issuing equity when their values are high and debt when their values are low. This predicts that signaling theories. This predicts that managers will select the firm's leverage levels to signal that the firm is strong enough to employ higher debt and fund its portfolio profitable investment. Various indicators show that capital structure does affect the value of a firm, but empirically observing the optimum capital structure is very difficult. Many theories of capital structure optimization suggest different strategies for fundraising but do not recommend mathematical modeling. No quantifiable effect on firm value suggested. Absence of mathematical modeling prevents quantifying the effect of changes in capital structure on firm value. Mathematical models could provide objective firm-specific recommendation for capital structure optimization. Mathematical model provides framework within which a problem could be analyzed like a linear programming model to minimize the cost of capital within some constraints. The factors driving changes in cost of capital varies with the firms in same industry, as investor perception matters a lot. Thus, finding one closed form mathematical model to optimize capital structure for all firms is very difficult. Measuring the effect of capital structure changes on firm value in real world is a major challenge. This problem remains regardless of the method used to optimize the capital structure. Some models track firm's value through regression model. Some models have debt equity ratio as a predictor variable, but the coefficient parameter for debt equity is generally low. Some major mathematical models for optimizing the capital structure would be evaluated in the next episode. So this concludes this video. Thanks for watching.